Starbucks just pulled off kind of the ultimate earnings paradox. They totally crushed bottom line consensus, but actually saw their revenue shrink. Adjusted EPS came in at 85 cents, which completely blew past the 66-cent consensus, even as revenue slipped 1.4% year over year to $9.32 billion.
Right, and the street is completely buying the paradox. I mean, management raised their fiscal 2026 EPS guidance to a $2.55 to $2.65 range, and they locked in a 6% global comp growth target.
Yeah, which is exactly why the stock jumped 5.1% after hours,
Yeah.
Flirting with its 52-week high near $110 right now. So for everyone holding SBUX or just watching from the sidelines, we really have to figure out how a company grows earnings by 30% when fewer top-line dollars are actually coming in the door.
Well, it basically comes down to shedding dead weight, or I guess more specifically, the China pivot.
Okay.
Yeah, so Starbucks transitioned its China retail operations to a 40% owned license model with Boyu Capital. By deconsolidating those direct store sales, reported international revenue immediately took a 34% haircut.
Wait, giving up direct control of one of your biggest global markets sounds like a massive red flag. Why is the market rewarding a 34% drop in international revenue?
Because of the liabilities they left behind. Operating thousands of stores directly means carrying, massive fixed costs. You've got real estate leases, local labor.
Right, the overhead is huge.
Exactly. By moving to a licensing model, they trade that heavy, low-margin operational burden for a capital-light royalty stream. So they take a smaller slice of the pie, but it's a slice of pure profit.
Which perfectly explains that massive margin inflection, because consolidated operating margins jumped 430 basis points to 14.4%.
Yeah.
For those tracking the cash flow, that basically means for every dollar Starbucks brings in globally, they are suddenly keeping over 4 cents more than they used to.
Precisely. And while the China pivot did the heavy lifting there, they also caught some pretty lucky macro breaks.
Like what?
Easing raw coffee inflation, for one.
Huh.
Plus, a one-time boost from international tariff refunds provided some really significant tailwinds for the bottom line.
Right. Let's pivot to North America, though, because the domestic numbers genuinely surprised me. An 8.1% jump in comparable store sales. I honestly assumed they were just aggressively hiking prices on lattes again.
Well, I mean, price hikes were certainly part of it. Ticket sizes grew 3.5%, but the real story is transaction volume, which actually grew 4.5%. They are physically pushing more customers through the stores.
But how? If you've been in a Starbucks during the morning rush, they usually look completely maxed out.
Right, and this ties directly into CEO Brian Niccol's Back to Starbucks initiative. It's essentially an overhaul of store-level operations. They've already completed over 1,000 coffeehouse uplifts, way ahead of schedule to execute on their green apron service goal.
Coffeehouse uplifts, that sounds like corporate speak for, new paint and better lighting.
It does, but it's much more structural than that. Think of it less like an interior design refresh and more like optimizing an air traffic control system for custom beverages.
Okay, I like that analogy.
Yeah, they are physically redesigning the bar flow, repositioning equipment, and streamlining prep stations. It's also baristas can shave critical seconds off of complex, highly customized cold drinks.
Meaning you get your iced matcha oat milk latte 30 seconds faster, which means they can serve like 5 more people an hour during peak times. That's the transaction volume right there.
Exactly. They are increasing throughput and driving revenue without needing larger physical footprints.
Okay, I have to play devil's advocate here. This all sounds fantastic, but let's look at the valuation you're paying for this efficiency. The stock is priced for absolute perfection. We're looking at a PE ratio sitting over 60 right now.
You're entirely right to be cautious. At a 60 multiple, a coffee company is basically being priced like a hyper-growth tech stock.
Right.
Any minor operational hiccup or even just a slowdown in consumer spending will mercilessly compress that multiple.
And looking at the institutional flows, the smart money seems to think the EV gains are over. Atria Investments just slashed its position by 19.6% in the second quarter.
And it's not just institutions either. We're seeing notable insider selling, including from CEO Brady Brewer.
Wow.
Yeah. Now, insiders sell for plenty of mundane reasons, but when you pair executive selling with aggressive institutional trimming at a peak valuation,
It's a pretty clear signal.
it is. It signals that the initial turnaround success is fully baked into the stock price already.
So if you are long Starbucks, you're enjoying that 62-cent per share quarterly dividend, but you are paying a massive premium to stick around.
You are. The operational execution is flawless right now, but the margin of safety for new investors is virtually zero.
Yeah, which leaves you with a much bigger question to mull over. Can Starbucks maintain this aggressive 7.9% global comp momentum? Or will a cautious consumer eventually balk at premium coffee prices now that the initial turnaround hype is priced in?
It's definitely something to watch closely.
Make sure to follow the show for your daily earnings coverage.